One wrong decision in a grey divorce, that's divorce after age 50, can cost you over $180,000. And the worst part, most people don't realize they've made the mistake until it's too late to fix it. Grey divorce has doubled over the past 30 years. If you're going through divorce in your 50s or 60s, you're dealing with complex financial issues that don't exist in younger divorces. Retirement accounts worth hundreds of thousands, decades of home equity, potential alimony, and less time to rebuild financially. In this video, we're covering the 5 most expensive mistakes people make in grey divorce and exactly how to avoid them. This information could save you 6 figures. Let's get into it. Mistake number 1, and this is the most common, fighting to keep the family home without understanding the real costs. Here's what happens. After 20 or 30 years in your home, there's enormous emotional attachment. You raised your kids there, it's filled with memories. So in the divorce negotiation, you give up other assets to keep the house. But here's what people forget: property taxes, homeowners insurance, maintenance and repairs, utilities. On a $400,000 home, these costs can easily run $12,000 to $18,000 per year. When you were married, 2 incomes covered these expenses. Now you're on 1 income, plus you may have bought out your spouse's equity. Here's a real example. Your home is worth $600,000 with a $400,000 mortgage. Your equity is $200,000. To keep it, you give your spouse their $100,000 share, possibly by taking less from retirement accounts. Fast forward 5 years, your house poor, struggling with maintenance, and your retirement accounts are depleted. Meanwhile, if you'd sold the house and each taken your share, you'd both be in smaller, more affordable places with better cash flow. Divorce attorneys see this constantly. The spouse who kept the house often ends up selling it within 5 years anyway, after burning through savings trying to maintain it. The better approach: seriously consider selling the home and splitting the proceeds. Use your share as a down payment on a right-sized, affordable property. Your future self will thank you. Mistake number 2, mishandling retirement account division and triggering massive tax penalties. Here's the mistake people make. They withdraw money from their 401k to pay their spouse's share, thinking this is the easiest way to divide assets. If you're under 59.5 and withdraw $50,000 from your 401k, you'll pay income taxes plus a 10% early withdrawal penalty. In a 24% tax bracket, that's $12,000 in income taxes plus $5,000 in penalties. You just lost $17,000 unnecessarily. The correct way to divide retirement accounts is through a Qualified Domestic Relations Order, or QDRO. This is a court order that directs your 401k administrator to split the account without penalties. With a QDRO, your spouse's portion transfers directly into their own retirement account, tax-free, no income taxes, no penalties, no hassle. Here's the math. A properly prepared QDRO costs between $500 and $1,500. The wrong approach can cost you $10,000 to $20,000 in taxes and penalties. But here's the critical part: the QDRO must be done correctly and filed promptly. Many divorce decrees say the parties will divide the 401k but don't create the actual QDRO. Then 2 years later, when you try to divide it, documentation is missing and account values have changed. Make sure your QDRO is prepared by a specialist, not just your divorce attorney. File it with the plan administrator immediately after the divorce is final, and get written confirmation that it's been executed. Mistake number 3, treating all assets as equal without considering taxes, and this one costs people huge amounts of money. Here's a common scenario. You negotiate to keep the home worth $400,000 and your spouse takes the 401k worth $100,000. Looks fair, right? Wrong. The home equity is yours tax-free when you sell it, up to $250,000 in gains if you've lived there 2 of the past 5 years. But that 401k, every dollar withdrawn is taxed as ordinary income. If your spouse withdraws that $400,000 401k in retirement at a 24% tax bracket, the after-tax value is only $300,000. You got $400,000 tax-free. They got $300,000 after taxes. Here's another example. You have a traditional IRA worth $200,000 and a Roth IRA worth $200,000. Your spouse takes the traditional, looks equal, but the Roth withdrawals are tax-free. The traditional IRA withdrawals are fully taxable. In retirement, the Roth could be worth $30,000 to $40,000 more after taxes. Before finalizing your divorce settlement, run the numbers with a CPA or financial advisor. Calculate the after-tax value of each asset. Make sure you're actually getting a fair split, not just an equal-looking one. You may need to adjust the division percentages to account for tax differences. If you're taking more taxable assets, you should get more total value to compensate. Mistake number 4. Failing to update beneficiaries and estate plans after divorce. And this one can literally give your entire retirement account to your ex-spouse after you die. Here's a real scenario that happens more than you'd think. You get divorced. The decree says you're both moving on separately. You remarry a few years later. Then you die unexpectedly. Your 401k is worth $600,000. Guess who gets it? Your ex-spouse. Why? Because you never changed the beneficiary designation on your 401k after the divorce. Your new spouse gets nothing. Your ex-spouse, who you haven't spoken to in 5 years, gets $600,000. This actually went to the Supreme Court. The court ruled that beneficiary designations override divorce decrees. Even if your divorce decree says your ex gets nothing, if they're still listed as beneficiary, they inherit the account. Within 30 days of your divorce being final, you must update beneficiaries on 401k accounts, IRA accounts, life insurance policies, bank accounts with payable on death designations, and brokerage accounts. You also need to update your will, revoke any powers of attorney granted to your ex-spouse, update healthcare directives, and change executor designations if your ex was named. This isn't optional. Hire an estate planning attorney to review everything. The cost is a few $100. The cost of not doing it. Your entire estate going to the wrong person. Mistake number 5. Rushing to settle without understanding your full financial picture and rights. Grey divorce is emotionally exhausting. The stress makes you want it over as fast as possible. Your spouse or their attorney might pressure you. Let's just split everything 50-50 and move on. But here's the problem. In a 25-year marriage, there may be assets you don't even know about. A spouse who handled the finances might have retirement accounts, bank accounts, or investments you're unaware of. Before you settle, you need complete financial discovery. This means getting 3 years of tax returns, statements for all bank accounts, retirement account statements, real estate appraisals, business valuations if either spouse owns a business, and debt documentation. If you're considering alimony, you need to understand the full income picture. Has your spouse been hiding income, underreporting earnings from a business? These details matter enormously. Here's a real example. One spouse rushed to settle, agreeing to $1,500 monthly alimony for 5 years. 3 months later, they discovered their ex-spouse had a second retirement account worth $300,000 that wasn't disclosed. Reopening a divorce settlement is extremely difficult and expensive. Most states only allow it for fraud or material non-disclosure, and you have to prove it. Take the time to do it right the first time. A typical grey divorce with significant assets should take 6 to 12 months to properly negotiate. Yes, that's longer than you want, but it could mean the difference between a fair settlement and losing hundreds of thousands of dollars. What to do first? If you're facing grey divorce, Here are your immediate action steps. Step 1. Hire a divorce attorney who specializes in grey divorce and complex asset division. This is not the time for a general practice attorney. Step 2. Gather all financial documents. 3 years of tax returns, all retirement account statements as of the most recent quarter, bank and investment statements, mortgage statements, and property valuations, and any prenuptial or past nuptial agreements. Step 3. Do not touch any joint assets without attorney guidance. Don't withdraw large sums from joint accounts, don't sell investments, and don't take on new debt. These actions can be used against you. Step 4. Consult with a financial planner who specializes in divorce. They can help you understand the tax implications and long-term financial impact of different settlement scenarios. Step 5. Protect yourself emotionally. This is one of the hardest things you'll go through. Consider working with a therapist who specializes in divorce and life transitions. Yes, hiring specialists costs money, but the potential savings from avoiding these 5 mistakes, easily $100,000 to $300,000. Summary of 5 mistakes. To recap the 5 most expensive grey divorce mistakes: keeping the house without understanding true costs, mishandling 401k division and triggering penalties, ignoring tax implications of different assets, failing to update beneficiaries and estate plans, and settling too quickly without full financial discovery. If you're going through grey divorce, you're not just dividing assets. You're protecting the financial foundation you'll live on for the next 20 to 40 years. Take the time to do it right. Subscribe to Midlife Money Method for more financial guidance on divorce, retirement, and wealth building. Next video covers estate planning essentials for second marriages. And remember, consult with licensed professionals for your specific situation. Every divorce is unique.